guys, welcome back to a brand new video. I'm RexFinance, and today is actually the first ever back-to-back daily upload on my YouTube channel. And this video today is actually a video that's part of a series that's been ongoing on my channel for quite some time now, actually since I started my channel in late April. And today, the video is going to be the top 3 stocks to buy for December 2020. Each installment in this series has gained in views ever since I started it, so I want that to happen again with this December 2020 video. So be sure, if you like this video, to leave a like down below, but also share this video with one of your friends or family members that might be interested in investing and is looking for ideas of companies to invest in. Also, since the markets are at all-time highs, I was very careful in picking safe investments that still had extreme growth capabilities. On that note, just because I don't mention a stock in this video doesn't mean I don't think it's a good buy going into December. We all know that I'm a workhorse and a clean spark bull, and I honestly think that it's a great time to buy both of those stocks this December. But I'm going to leave them out of this video just because everybody knows that that's my opinion already, and I want to add more variety to this channel. So all 3 stocks that I mentioned today are either stocks that I have barely mentioned on my channel in the past, or they're completely new to the channel. In fact, the 3rd stock in this video is one that I think you guys probably don't know about, but that I'm extremely confident and I'm really excited about investing in it in the future. So the last 2 housekeeping items are, I want to know what stocks you're buying this December. So let me know 2 or 3 stocks you're looking at currently down in the comments section below. Also remember, as we go into this video, that I am not a financial advisor. I am just a 19-year-old with a passion for stock market investing, so do not blindly follow what I say in this video without doing your own research and at least reading through each company's investor presentation and their latest 10K. So without further ado, let's get right into the video. So the first stock we're talking about today is ticker symbol PIC, which is a SPAC play, and I think it is one of the most, if not the most, undervalued SPAC investment currently. And I'll get into that a little bit later, so stay tuned for that. But basically, XLFleet has one competitor, and that is Hyliion. And for those of you unfamiliar with what Hyliion does, is they transform traditional fossil fuel powered engines on Class 8 vehicles to more electric or hybrid versions. Now, like I said, Hyliion is focused on Class 8 vehicles. However, XLFleet is focused on Class 2 through 6 vehicles, so they're in the same niche, but they have completely different target markets, which is big because that means there's little to no competition. So the first thing I should probably mention is that this is a clean energy or an electric vehicle stock play. And in my opinion, there's no doubt that 4 years from now, 4 years down the line, we're going to make money in clean energy and electric vehicle stocks just because the government has been and will continue to push heavily for cleaner energy and electric vehicles. Now, this is the first time I've ever mentioned this company on my channel. And with that, what makes me so excited about this investment is that it meets all of my criteria. For those of you out there that aren't frequent viewers of my channel, I have a pretty strong track record, and it's because of the criteria I set for all of my investments. If they don't meet my criteria, I don't invest in the company. But this stock, this company meets all of that criteria, which is incredible because it is so rare that I find a new company that meets that criteria. So I should probably go through what criteria I look for in these types of companies and investments before I continue with what this company in particular does. Basically, what I look for out of investments is triple-digit revenue growth in the past, in the present, and in the future. So what I mean by that is that their revenues compounded annually increase at 100% or more over the past couple years, currently, and for their projections going forward. On top of this, I look for companies that have a niche in a booming industry, along with a head start on all of its competition. Now, XLFleet in this case has an early advantage and they have an early lead in this sector. And the last criteria I look for is that the company has little to no debt on their balance sheet. What I look for is these smaller companies that aren't recognized yet with huge upside potential that are doing everything right and have very little debt. Because with these cheaper companies, there's more risk inherently with these investments. But if you find these smaller companies with little to no debt, it decreases the risk of these types of investments drastically and really increases the chances of a positive investment. So first, let's talk about this niche. Generally, what you see from EV companies is they are manufacturing brand new vehicles and putting them on the market. But in XLFleet's case, they are just transforming old traditional combustion engines into plug-in hybrids, or fully electric motors. And why that is big is because fleets probably don't want to throw all of their newly purchased vehicles out the window because they are combustion engines. They probably want to ease into this transition into clean energy and electric vehicles because, everybody knows the benefits of electric vehicles in the long term. It's just a higher upfront cost, but it saves you so much money in the long term. So what XLFleet and Hyliion do is they transform their old combustion engines into those electric or hybrid engines for a much cheaper cost. And then if they see the results they want to see, they can start buying these new electric vehicles off the market instead of transforming their old vehicles into the hybrids or electric versions. And like I mentioned earlier, there's really only two competitors in this niche of the EV industry, and that is XLFleet, which we're focused on right now, as well as Hyliion. But those two companies are focused on two completely different segments of this niche in the industry. Hyliion is focused on the Class 8 powertrains, so that's your tractors or semi-trucks. XLFleet is focused more on the traditional fleet pickup truck or fleet transit van. And the reason that excites me so much is because in this industry, there is a global total addressable market of over $1 trillion. And if two companies are focused on one niche, that is going to be great revenues for both companies going forward as long as the industry trends stay intact. So as long as Hyliion and XLFleet stay in their own lanes, they don't really have any competition and they're just competing with themselves to create the best product and service possible. Now, my favorite line in this entire investor presentation is probably the one that's on the screen right now. Selling existing products to existing customers through existing channels. And if we scroll up to another slide, we can see that this is entirely true. XLFleet has that early head start on all of its competition. They have sales. They have more sales than Hyliion, Workhorse, Nikola, and Lordstown already. And they're projected to continue that trend. And it's pretty nice to see their customer base filled with familiar names like FedEx or Safelite or Pepsi or even Yale University. There are so many applications for XLFleet's products and services. And probably the biggest deal for me personally is XLFleet's financials. They are outstanding. There's going to be zero material debt after the merger is complete. Now, like I said earlier, having zero debt in a new company that is growing is a huge deal because they don't have that risk of going bankrupt. We can also see on this slide that it meets my criteria for revenue growth. Going forward, they're expecting over 192% and upwards of 200% annual revenue growth year over year. That is exactly what I look for. And that is huge going forward with zero material debt after the merger is complete. And something I want you guys to pay close attention to on this slide is that by 2024, they're projecting to do $1.4 billion in revenue. And that is part of the reason I think this SPAC play is grossly undervalued. If we scroll down, we can see that the implied enterprise value when this investor presentation was put together was $1.1 billion. So within 4 years, they're projecting to do more revenue in 1 year than their current market cap. And the reason that's a big deal is because a lot of these growth companies have at least 5 years of revenue priced into their market cap. And when you see that 4 years down the road, they're going to be doing more revenue than their current market cap, you know that it's undervalued and it's a pretty good investment where it is today. Another big thing I should note with SPAC plays is they traditionally crash after the merger takes place because they have investors that sell out of their shares looking to make money or a profit. And the majority of the sell-offs is normally caused by PIPE investors. But we can see that PIPE investors are only going to make up around 10% of the combined company. And that is big because that is such a small number in comparison to all the other shareholders of the combined company. Typically what you see in SPAC plays is over 20% of the combined company being owned by PIPE investors. And these PIPE investors sell out of their shares. So when they have a high percentage of PIPE investors as a part of the combined company, it only makes sense that that would cause a massive sell-off. But since the PIPE investors make up such a small portion of the combined company for XLFleet after the merger, I really don't think we're going to see the share price go down much, if at all. So my second recommendation for today's video is a company I've actually talked about briefly on my channel in the past. But this was just a case of there's no way I couldn't include this stock in today's video because there's so much upside potential and I have not talked about them near enough. This company is ticker symbol FLUX or FLUX Power. I originally bought shares of FLUX Power at $5 per share, and lately I've been kind of swing trading their shares. Now, I don't recommend swing trading whatsoever. It's just a way that I've been trying to make some money on the side, along with my long-term investment in this company. And when I first invested in this company, I made it clear on my channel that this was a very risky investment. It is a high debt growth play. But I saw that it met most of the criteria I normally look for in that revenue growth and in that niche in a booming industry. This again is a company that is a part of the electrification movement across the world, but it's in a different way than you would normally expect. As we see on the first slide in their investor presentation, we see a lot of forklifts. And that is what FLUX Power is primarily focused on. They manufacture lithium-ion batteries for the material handling sector. So FLUX Power is really the leader in the electrification process of forklifts, but they also help with electrifying airport ground support equipment or GSE. Now they are working with Delta Airlines, and Delta Airlines, along with some other airlines and airports, have ordered some of these batteries for the ground support equipment. And Delta Airlines has long been the leader in all of the change that has come for all of the airlines over the past decade. They're normally the airline that's willing to try something new, and if it works, all the other airlines follow suit. And Delta Airlines is really liking what they see with the electrification process of their ground support equipment. So I would not be surprised whatsoever to see even more airlines and airports pick up FLUX Power batteries to electrify their ground support equipment. However, the two most exciting things about this company are that they also provide lithium-ion batteries for Envision Solar, which is now known as Beam Global. They provide those batteries for their solar-powered electric vehicle charging stations. In addition to that, FLUX Power provides their batteries for warehouse robotics. And with all the demand lately for same-day or next-day delivery, warehouses have been popping up left and right in every single state in the United States of America. Companies like Amazon predict spending habits from customers in different geographic locations and demographics. And by doing that, they also need new warehouses to ship those predicted products to those warehouses so that those products can be delivered on the same day or the next day after an online order. So I mentioned earlier that FLUX Power has always been a risky investment for me, and I was upfront and center with you guys about that. But looking forward, what I wanted to see when I made that first investment was I wanted to see them decreasing their debt every single quarter. I also wanted to see them increasing their margins every single quarter, and I wanted to see them increasing their revenues every single quarter. And ever since I have owned this company, they have met all of that criteria, so that makes a very happy investor in me. And in fact, in fiscal year 2020 for FLUX Power, they grew revenues at 80%. So that's not quite the triple-digit revenue growth that I normally look for, but that is still phenomenal, and I'm extremely happy with that. They also project that that revenue growth is going to continue as their full product line advances and they get more orders for each and every single one of their new products. So back then, just seeing the experience that their management team had with handling the financials of different publicly traded companies, I took a calculated risk and it's really paid off so far. Now, I will continue to look for each of those things, but every single quarter that goes by where they meet each of those three criteria, the risk of the investment goes down. They've decreased their debt drastically, they've grown their margins, and they've grown their revenue. Another exciting thing surrounding FLUX Power currently is each of the last two conference calls, they've mentioned the possibility of M&A or mergers and acquisition. So they're looking to grow via an acquisition, and I'm really excited to see where this goes for FLUX Power. They're at the point and they're at the stage in their company's life where they need to be looking at how to grow best and most efficiently. And obviously they think that's through an acquisition. So I'm going to be paying attention to what company they acquire and what they bring to Flux Power, but I think it's going to be phenomenal. Now, last but not least, I am very excited about this third recommendation for December. I actually found this company thanks to my old high school business teacher a few years ago, so I know he watches some of my videos, so special shout out to you. But just recently, I started looking into this company again. Now, in addition to the first two stock recommendations that I put in this video, this is more of a conservative investment. And because those first two were a little bit more risky and not as well established companies, I really wanted to look for a company for my third pick that was more conservative but still had that tremendous growth and upside potential. So stay tuned for this one because I know a lot of you guys are going to like this company. So this is definitely a safer investment. They've maintained around a 30% CAGR or compound annual growth rate in their revenues. They also have very minimal debt in comparison to how much cash they have on their balance sheet. And what ShotSpotter does is they provide precision policing and security solutions for law enforcement in the United States of America, South Africa, and the Bahamas. So they have a lot of international growth potential, but they are already well established inside of the United States of America, which is what I'm going to be primarily focused on. ShotSpotter has plenty of growing business segments. And the first one that I want to go over is the most exciting one that will excite you guys probably the most as well. And it's called their FLUX product or ShotSpotter FLUX. It identifies, locates, and deters gun violence by incorporating a real-time gunshot detection system. Now, this is one of those products that I was very surprised I hadn't thought of previously, but that is extremely powerful technology. And another thing I really like about ShotSpotter is that almost 100% of the revenues come from software subscriptions. And the reason that is big is because a subscription model keeps customers around and they rarely leave. And that's also a testament to ShotSpotter and the quality of service that they provide. So their next business segment is ShotSpotter Missions, and it is a cloud-based patrol management solution that helps plan patrol missions and tactics for crime deterrence. So already you're getting a feel for this company and seeing that it's all about deterring crime and gun violence. Another one of their business segments is called ShotSpotter Secure Campus, and it's exactly what it sounds like. It helps secure educational campuses all around the world. It notifies police and first responders whenever it sees something fishy going on. The next business segment that ShotSpotter has is called ShotSpotter Site Secure. And what Site Secure does is it safeguards critical infrastructure like train stations, airports, and freeways. Last but not least, ShotSpotter Labs is a technology that helps address significant wildlife and environmental issues. So it's not all about violence and crime. There's a lot of business segments here that I'm really excited about, and they've been growing steadily. Like I said, the revenues have been growing at 30% compounded annually. Also, something to note is ShotSpotter has a very small share float. So that means there's very few shares publicly able to trade hands throughout the trading day. Now, that can create a very volatile stock if this stock gains a lot of traction and attention going forward. This is one of those companies I look at and I'm confused at how somebody could not like what ShotSpotter does, their financials, and really their growth. Now, ShotSpotter's stock price is around $33 per share, but it's still a very small company. Their market cap is only around $370 million. So it technically is still a penny stock, even though its share price is $33. Now, if we scroll through these slides, we can see that this company, just like I've already mentioned, has extreme upside. They have almost 17,000 sensors deployed in over 100 municipalities and cities with over 140,000 gunshot alerts and a radius around 770 square miles under contract. Now, that's a big deal. They've stopped a lot of crime, I'm sure, just from those statistics alone. But when I look at those statistics, I also think in my head, this company has a lot of room to grow domestically, not even accounting for overseas or international growth. Obviously, ShotSpotter helps deter crime, but it also allows police to get to the scene much quicker, which can save lives. Here on this slide, we can see the great results that they've seen, and these are tangible results. These are real results. These aren't projections. They had 66% reduction in shooting per mile in Oakland, California. They had 46% decrease in homicides in Camden County, New Jersey. They had 102 arrests made with the help of ShotSpotter in Denver, Colorado, and they had 40% decrease in gunshot incidents in Rochester, New York. So again, from the outside looking in, how could you not like this company? So now as we keep scrolling through this slide deck, we can see that revenues have been growing very steadily quarter over quarter, which is something you really like to see. And this is really a company that won't be impacted from a market downturn, just because its products and services likely will be applicable no matter what happens across the world's economies. They even say on this slide that they've had a compound annual growth rate in revenue of 36% over the past 5 years. So ShotSpotter has a really high margin business model. They've been growing revenues consistently and they have very minimal debt in comparison to the amount of cash they have on the balance sheet. Now, even though this stock is $33 per share, it's still a penny stock. It's still an emerging growth company, which makes me so excited going forward. It also has a low float, like I mentioned. So if this gains some traction, gains some popularity, and we keep seeing the results that we want to see from ShotSpotter, we can see some really good return over the coming years. So in closing, thank you very much for watching this video. Let me know down below which company that I brought to you today was your favorite. Also leave a like if you enjoyed, and feel free to share this with a family member or friend that is interested in investing or is potentially looking for new investment opportunities. Today we talked about PIC Stock, we talked about FLUX Power Stock, and we talked about ShotSpotter Stock. All three companies I believe to be good buys. Again, I am not a financial advisor, so do your own research outside of watching this video, but I'll be back with a brand new video tomorrow. Thanks for coming out. Peace out.